Hey, what's up guys? Alan here with EatSleepTrade.net, and I'm going to be bringing you guys a lesson video on probably one of the most common questions that I ever get asked, and also is going to tie in a little bit to having a proper risk management in all your trade setups, and also using the proper position sizing to set yourself up for success. So we're going to be going over those three things in this video. If you guys appreciate these lesson videos, do me a favor, hit the like button down below. Don't forget to hit the subscribe button as well so you can be updated as soon as we upload new videos. And leave a comment down below. Let me know what you guys think of this video if you have any questions or suggestions. Alright guys, so it's the most common question that I get, and that question is how much money do I need to start trading? And unfortunately, there's no direct answer to that question. There is no set amount of money that you're going to need to begin trading. It's all going to be based off the type of trading that you're doing. It's going to be based off the type of trade setup or plan that you're trading. So it's going to vary. Every trade that you make is going to vary from the amount of capital that you will need in order to successfully put that trade on with a proper risk and a proper risk management plan. And there's no direct answer, but we're going to go over in this video how you can figure out the amount of money or capital that you need to start trading. And obviously if you have an account size that's $50,000, well, yeah, that's probably going to be enough for you to start trading and get your feet wet a little bit. Of course, if you're coming in brand new to trading and you're just jumping in with $50,000, hopefully you've spent the time to put together a proper risk plan so you're not just throwing all your money away into the markets. But what about if you have a smaller account? What if you only have $5,000, or what if you only have $2,500? Or even smaller, only $1,000. And let's be honest, the most common amount of money that people try to come in and start trading with is going to be $1,000. They think, well, I don't even know if I want to be a trader. I don't even know if this is something I'm going to want to pursue. So, I don't want to put $50,000 into something that I'm not sure if that's even what I want to do. And they get the mentality of, let's start small. I'll just put $1,000 in a trade, buy a couple stocks, and let's see if it works. And unfortunately, that's just the complete wrong mentality, and that's not the way to success. But we're going to talk about how much money do you really need to actually begin trading. And one of the things that's going to determine that is what type of trader you're going to be, and whether that's going to be if you want to be a day trader. If you are going to want to be a day trader, then you've got to think about things like a pattern day trader rule, which requires that you have a minimum of $25,000 in your account. So is $25,000 the minimum amount you need to start trading if you're going to be a day trader? No, not necessarily. There's brokers out there that will offer you ways to get around the pattern day trader rule. Now, I'm not saying that's the best route to go and that you should go to an offshore broker who will allow you to get around US rules, but that is an option, so something to keep in mind. And if you're going to be a swing trader, what type of capital do you need if you want to be a swing trader? Obviously, you don't need a minimum of $25,000 account to get around a pattern day trader rule, because you're not going to be buying and selling securities in the same day very often. So you're going to need, per se, a little bit less money than you might need if you were an active day trader, but you're still going to need a fair amount of capital, and we're going to talk about that as we move forward here just a little bit, and discuss how much money you actually will need to pull off a swing trade. And then last but not least, if you're going to be an investor, how much money do you need? And I would say that, opposite to common belief, that investing actually is going to require less money than a day trader or an active swing trader, because you're going to take your capital, you're going to typically put it into maybe one or two things that you plan on holding for multiple months or multiple years, and there's not a lot of movement within that money. You don't have to worry much about your commissions, your fees, or anything like that pattern day trader rule. So the amount of capital that's going to be needed is always going to be determined by what you're trading, what your trade plan is, and what your set risk is. So let's go ahead and start taking a look at some of those. Now, risk management is the key to survival in the market. If you're coming into the market and you don't have any type of basis on technical analysis, or you don't have any type of basis on fundamental analysis, and you really have no idea what you're doing, but you have a set plan with how much capital you're willing to risk, you're going to be one step ahead of any person who comes into the market without that set risk. And risk management is the number one most important rule. And if you break this rule, it will end your trading career very quickly. So no matter what your idea is, no matter what type of trader you are, no matter what your style is, risk management is going to be the key to survival in these markets, especially if you're a new trader and you're still trying to learn the market or learn your niche or figure out exactly what type of trader you're going to be, what type of setups you like, whether you want to day trade or swing trade. The number one most important rule is to having a good risk management. Now, risk management, there are two main levels of risk management that we're going to talk about in this video. So let's go ahead and let's talk about the first level of risk management. Now, the first level of risk management is also going to be the most important level, and there's a big warning sign on this, because if you as a new trader, as an existing trader, as a vetted trader, you as a trader, if you do not follow your first level of risk management, then you will not survive in the market. Plain and simple as that. And the first level is going to be your max loss of capital per trade. And that's how much of your capital, of your total account value, that you're willing to lose per trade. And if you've watched some of my other videos, and you know that as a trader, the chance of you having a win ratio of 70% is very, very unlikely. And a win ratio of under 50% is much more likely. So if you're not having a max loss of capital per trade, and you're letting your losing trades add up to much bigger losses than what your winnings are going to be able to recover, then you're going to set yourself up for failure right there by just having an average win ratio of less than 50%, because that's what most traders are going to average, something less than 50%. Yes, as you grow and become a better trader and understand the psychology and the emotional side that's involved in the market and what's actually causing market movements, you can increase your win ratio, and maybe get it up to 60% or 70%. But either way, max loss of capital per trade is so important. And for me, my max loss of capital per trade is that 2% mark. And it's so simple to follow, and that's why I use it. It's just straightforward, simple. Do not lose more than 2% of my account value on any single trade. This will prevent large drawdowns and allow you to recover quickly if you have a losing streak and get back into profiting trades and getting your account to new highs. So an example of using 2% as a max loss, if you have a $5,000 account size, well then following this first level of risk management, you should never risk more than $100 per trade, ever. Period. Do not do it. If you have $5,000, you should not risk more than $100 per trade, period. No exceptions. If you find an exception, you're wrong. No exceptions. Secondly, so if you had a $2,500 account, then we would just cut that risk in half. You would be risking no more than $50 per trade, period. If you have a trade plan that is requiring you to risk more than 2% of your capital, then that trade plan is not right for you, or your account is not large enough for that trade idea, and you should step away from that trade idea. Always follow it, see how it works out, make notes if that setup worked or not, but you don't have to trade it if it doesn't fall within your risk tolerance. Now, the second part to the first level of risk is, or just risk management in general, is having the discipline, okay, to stick with your plan. Yes, we can create a risk plan, we can have risk management, we can create a max loss, but none of that matters if you don't have the discipline to stick to your risk management plan. And a lack of discipline will jeopardize your chances at trading success, guaranteed and almost immediately. So discipline is going to be a huge factor in all of trading, and especially when it comes to risk management. Now, let's take a look at the second level of risk management. Now, this is on a much smaller scale, and we're going to be looking at what a risk versus reward is at a price per share level. So one of the main things you need to be concerned about is how much are you risking and what is your possible reward, and that is at a price per share level. So if in your trade plan your nearest support area is 20 cents below your entry, so you are risking 20 cents at a price per share level, 20-cent risk, and you need to have a favorable risk reward of at least 1 to 3. So what that means is if you are risking 20 cents on your trade plan, then your reward should be at least 3 times that. So if you have a 20-cent risk, your reward should at least be 60 cents to the top side. And what this does is allow traders who are new to the markets and have an unfavorable win ratio, such as a 40% win ratio or a 45% win ratio, it will allow them to let their winners pay for multiple of their losers. And this idea of a positive risk versus reward ratio is a huge characteristic on the difference between a successful trader and an unsuccessful trader. So what you need to find out on your trade plans as well is not just are you within your max risk on capital, but do you have the right risk versus reward setup on this specific trade idea? And does that risk versus reward setup fit within your max risk per capital? So there's 2 levels of risk management that we need to pay attention to. And one is going to be our max loss of capital, and that's going to prevent large drawdowns in our account, because there's reality is that we are going to have losing streaks, and you're going to have days or weeks where you just can't catch a winning break. And that could be because market conditions are bearish and the market itself is trending down, which makes it much tougher for anybody who's trying to get long. That could just be from emotional stress that you have in your life that is affecting your mind and the way you're thinking, the way you're reacting to the markets and trading in general. So it may not even be anything bad within the market. It could just be bad within yourself, your emotions, and the way that you're thinking or stress that's affecting you outside in your life that could cause these drawdowns in your account. And it's so important to put a set risk on these drawdowns and make sure we're trading with positive risk versus rewards. So when we get these drawdowns, one, they're not huge, but they are also easily recoverable from, and we have no problems reaching back out and getting our accounts to new highs. All right, guys, so we are here looking at Fidelity's Active Trader Pro, and I'm going to go over a couple scenarios and examples with you guys of how much money you would need to trade a specific idea, what your risk versus reward is, and what's your max capital per trade that you're risking on a trade like this, or that we're going to talk about here. And the example we're going to use today is AMD, and I think this will be a great chart for a good example because it's just been an uptrending chart. We've had a lot of trades in it, and it's just going to give you guys a perfect example of how a proper risk versus reward entry should work. Okay, so let's go ahead and we'll zoom in right here so we can get a little closer look. So let's take a look at this little pullback consolidation that we had after a breakout here on AMD, and let's talk about the entry that we made right here. And now let's say that we bought at the high a day on entry here, and our high was 517. So let's go through and just use an example and say, in this example, our trade idea is to purchase shares at $5.17. Now, we have to decide where is our set risk going to be on a trade like this. Now, in hindsight, it's always going to be easy to decipher where you should be setting your risk. But if the rest of the chart didn't exist, and let's see where we're at here. If the rest of the chart didn't exist, and this is where we are buying in, then we need to find a set risk area. And there's 2 areas on this chart right now that we could use as a set risk. And the first area is going to be our support area, which was a resistance we broke out, now turned support. So that's going to be the first area that we could possibly use as our risk. And that area right here looks like it's going to be 470. So let's go over here to our trade armor, and let's put in 470 as our stop, or what will represent as our risk. So now we have a buy area that we're going to do at 517, and we have our risk set down here at a support area near 470s. Now our idea or our reward is going to be for the stock to make a move back up to its prior highs, obviously break out of those prior highs and into new highs. But our reward at this point in time right now is going to be up here at 550. So let's go ahead and put in 550 for our upper limit on what we could possibly win on this trade right now. So let's just take a look at these three numbers that we're talking about. Our entry at 517, our risk at 470, and our reward up here at 550. So taking a look at our risk, and let's say that let's just start small here, and let's say that we have 100 shares of this, okay, for our example, just so we can get some math calculations here. Now, our estimated stop loss is going to be a 9% loss or $47, okay, and our estimated gain is going to be $33 or 6% gain. Now, in terms of a risk versus reward, does it make sense to make a trade like this? This trade worked out for us. We already know that because we're looking in hindsight. But in the moment and in the time of making this trade, does it make sense to make this trade with your risk set at $4.70? And the answer is no, it doesn't, because we're risking 47 cents, or it would be, with 100 shares would be a loss of $47. We're risking 47 cents for a possible reward of 33 cents. So we're going to lose more money than we're going to make. So in that case, less losing trades will still draw our countdown, even if we have a positive win ratio, which of course we've already explained is unlikely. You're more likely to have more losses than you are wins. So a positive risk reward is going to be a huge factor in determining whether you should enter a trade at this time or whether that's where your calculated risk should be. So let's say that we decided that risk is not going to work for us. We still believe in our chart setup and we have a strong trending chart and it's breaking out of this consolidation. It's holding the 20-day moving average and we really have a good entry here. But obviously risking down to 470 is just going to give us too much risk if we're wrong. So what we're going to have to do is move up and try to find a higher risk area that we could use that would still represent if we were wrong and let us know that, hey, we should sell because our idea is not working and the move's going against us. So just taking a look here from our entry date, we could see that our low is right around $5 and the low on the previous day was right around $5 as well. So $5, mentally is going to be a whole number that a lot of people focus on. Maybe they're trading the break over $5, maybe they're selling at $5, maybe they're risk at $5. $5 is a good emotional whole number that people will really pay attention to. And if $5 starts to break down, you could really see some selling pressure just because of the fact that it's a whole number and a lot of people are going to be watching that same whole number. So let's say that we decided to use $5 as our risk because that was the low a day on our entry. So let's go ahead and go down to our lower now and say we're just going to risk to $5. So now we're risking $17 or 3% for a possible profit of $33 or 6% if we're able to make it back up to prior highs around 550. So now we're risking 17 cents for a possible reward of 33 cents. So now you can see we have at least a 1 for 2 risk versus reward, and that's just with the idea of us returning back to a prior high. The idea of a chart or chart continuation or trend continuation is that you're going to put in new highs like we've continued to do, as you can see in the past, a new high, a new high, and a new high. So now we've set ourselves up with success because we have a minimal risk with a great first area of reward that is still giving us a positive risk reward ratio, and anything that we get breaking out to the new highs for a trend continuation is just bonus and extra profits over and beyond what our initial trade idea was. And what I really like to do in trades is scaling out of my trade. So if you guys follow me, you know my favorite thing to do is scale out of a trade. And the main reason for this is, so one, I can lock profits, which allows me to be more patient with the current position that I have left. And two, it's going to allow me to hold tight for that bigger breakout type move or for that move that goes up into new highs. So right now on this chart setup, we have a good or a proper risk versus reward entry. with our buy here, and we have an idea of where our first target's going to be, how we're going to sell out of that, and now we need to figure out, do we have enough capital to trade a stock like this? Do we have enough capital to make this trade idea fit into our number one rule of never risking more than 2% of our total account? So let's pretend that we had a $5,000 account and we cannot risk more than $100 per trade. We're going to come over here, and right now we could see that we're risking $17. So obviously, we need less than $5,000 to make a trade on this. But let's say that we wanted to use our max risk per trade, which is going to be that $100 mark. So that's going to be, let's see, about 400 shares. Oh, we can get a little bit more than that. Still going up. This is looking pretty good for us. Okay, so let's say that now we're going to decide to use 600 shares. Okay, so the required capital to produce the trade that we're looking at right here, where we could risk 100 to make close to 200. So now with your total account is $5,000 and you're within your risk per trade, and the amount of capital that this trade is going to cost you here is $3,000. So if you, let's say you only had an account size of $3,000. Well, if you're going all in on your account here and your account is only $3,000, well, that only gives you enough risk to risk $60 per trade. So looking at this now, if our entire account value was $3,000, now our trade idea does not work. If we have a $5,000 account, this trade idea will work with our risk management plan. However, a $3,000 account size only allows us to risk $60 per trade. So what we'd have to do is, one, we'd have to adjust our risk or adjust our position size. And you don't really want to adjust your risk right here. You have a very tight risk at $5. You're talking a 17-cent risk. So that's a very tight risk, especially in a stock that moves more than 17 cents on a day. So it's very plausible that you get stopped out on a trade like this if your risk is that tight. So what we would have to do is, we don't want to make our risk more tight than what it already is, but what we would do is decrease our position size to allow it to fit in with our max risk per trade. So here, if we had a $3,000 account size, this exact trade idea would work again with 350 shares with a buy at $5.17, risking at $5 with your first reward mark at $5.50. Still giving you that 1 to 2, which is a bare minimum. Always best to try to shoot for 1 to 3, 1 to 4, 1 to 5. But again, our reward is really going to be higher than $5.50, but this is almost like our minimum reward. So at a minimum, we're looking to get 1 to 2 risk first reward on this trade. Our max reward is going to be wherever this trade could break out into new highs. Nobody knows where that would be. So there's an example of how you use a risk first reward in combination with your max loss of capital per trade. Plug it into your trade ideas so you guys can see if you're trading the right ideas and if those ideas fit into your risk management. Now, it may seem like, how am I going to figure all this stuff out on a day when I have 10 minutes to decide if I need to pull the trigger or not as the stock is making its move higher or volume is coming in, and you've got to make that decision of buy or sell right now, and I don't have time to go through all the steps you just showed us to figure out if I'm within my risk. Well, I'll tell you guys, as you trade and you become more comfortable with your account size and what size account you're using, it will become second nature for you to understand where you should be risking, how much you can risk, and what your max risk per your account is. All of that should be known far before you even begin thinking about trade ideas. So all you're really making sure is that your idea is going to stay within your max risk and that you have a positive risk reward, and that is going to set you up for your best chances at trading success. So let's just take a look at the trade here that we made back in July and how it worked out for us. And as you guys can see, once we made that buy, as we started coming out of this consolidation, the stock itself never returned back down to $5. So there was never a shot of getting stopped out. And before you know it, a big volume day comes in and boom, you're right up to your first reward at 550. And this is where I was talking about where you could scale out of your position. This would give you an opportunity to take half your profits right here and let you use the last half to be patient and maybe wait for that new breakout to new highs like we were just talking about. So let's see what happens after that. And what do you get? Your nice breakout, you locked in half, and it starts to set up a flag. A good inside consolidation day, no worries at all on that. So we came all the way down and tested 510. So now let's say that you were in this trade and you did not lock half your profits up here at 550. And now you have your whole position and this day comes on to you and you're coming all the way down to 512. You're not at 510 yet, but you just seen a nice win of $100 turn into, again, maybe a small win or even heading towards a loss, and you see the volume coming in. And if you still have a full position size on your table, these type of days can scare you out of your position and cause you to sell when you shouldn't be selling. So locking in those profits at a resistance area, half your profits, a third your profits, scaling out of your positions gives you the patience and gives you the emotional capacity that you need when you see your money being taken away from you to hold that trade to wait for that bigger breakout. And as you guys can see, the breakout was pretty huge on this and made a move all the way up to $7. So yes, if you scaled out here, did you leave money on the table because the stock went to 7? Yeah, of course you left some money on the table for that first half or that first third that you scaled out. But I'll tell you what, if you sold right here, you left a lot more money on the table, and these emotions will get to you, especially if you think it looks like this was a day where they released earnings, something you would expect to be positive for AMD because every earnings has been a big breakout. But for whatever reason, they release earnings and the stock sells off. It makes no sense and goes against everything that should be happening. But that's how the market works. Whatever you think should happen is not what is going to happen. And that's why you got to set yourself with a positive risk reward. You have your max loss, scaling out of your position so you can lock profits and eliminate more of the emotions that are involved in trading, increasing your amount of patience that you can have and allowing you to hit those bigger breakout moves. Alright guys, so that is going to wrap it up on our quick lesson video on risk management and proper position sizing and letting you guys know how much money you actually need to start trading, as there's no direct answer to that question. Nobody's going to say, hey, you need $2,000 to start trading, boom, go, it should work for you. Unfortunately, that's just not how it's going to work. It's going to be so different on all the trade ideas that you have, the amount of cost of stocks that you're trading at a price per share level, a proper risk versus reward, and most importantly, having the discipline to stick to your risk management plan so you can survive the markets. So while there is no direct answer to how much money you will need to start trading, hopefully you guys should be able to figure that answer out now and keep a positive risk versus reward and prevent any large drawdowns that could be detrimental to your account and to your guys' trading career. So I thank you guys for watching. If you have not already, please do me a favor, hit that like button down below. If you guys have any questions or suggestions, please leave them in the comments down below. And don't forget to subscribe for future video uploads. Also, check out our website, eatsleeptrade.net. From there, you can follow me on Twitter, as well as like our Facebook page. And there you can keep up to date on all the stocks that we are watching and trading. All right, guys, thank you for watching. Good luck with your trading, and we will see you in the next video.